Good morning. Today we initiate coverage on the critical infrastructure underpinning the generative AI supercycle. While retail attention fixates on GPU designers, institutional capital is aggressively pivoting toward the true structural bottleneck: advanced packaging and high bandwidth memory, or HBM. AI processors are only as powerful as their data transfer rates. Without 2.5D and 3D packaging technologies bridging logic and memory, the theoretical teraflops of modern GPUs are heavily bottlenecked. Our thesis posits that the value capture in the semiconductor supply chain is migrating rapidly toward interconnects and packaging pure plays. We project a secular re-rating for key participants in this ecosystem. In this briefing, we will deconstruct the market dynamics, analyze revenue CAGR trajectories, evaluate critical valuation multiples, including NTM/PE and EV to EBITDA, and present our proprietary bear and bull case scenarios for the advanced packaging cohort over the next 36 months. Analyzing current market dynamics, we observe a definitive paradigm shift driven by the breakdown of Moore's law and physical reticle limits. Historically, monolithic die scaling drove semiconductor performance. Today, that approach is economically unviable and technically constrained by reticle limits at 858 square millimeters. The solution is chiplet architecture, enabled by advanced packaging. We are tracking a massive supply-demand mismatch in chip-on-wafer-on-substrate, or CoWoS, capacity. Lead times for CoWoS packaging currently stretch beyond 9 months, creating a definitive ceiling on total global AI GPU shipments. Furthermore, the memory wall problem is compounding this issue. Logic compute speeds have outpaced memory bandwidth capabilities by a factor of 10 over the past decade. Consequently, packaging multiple HBM stacks directly adjacent to the compute die on a silicon interposer is no longer optional. It is a mandatory architectural requirement for large language model inference and training. Turning to our TAM expansion models, the revenue CAGR projections indicate aggressive structural growth that outpaces the broader semiconductor sector by a multiple of 3. We modeled the total advanced packaging market scaling from $32 billion in 2023 to approximately $82 billion by 2029, representing an annualized growth rate of 17%. However, isolating the AI-specific advanced packaging segment reveals a significantly steeper curve, with projected revenue CAGR exceeding 35% through 2028. In parallel, our quantitative analysis of the high-bandwidth memory subsector suggests a TAM expansion from $4 billion in 2023 to an estimated $24 billion by 2026. This exponential growth is driven by both volume increases and substantial average selling price, or ASP, premiums. HBM3E is currently commanding a 5x price premium per gigabit compared to standard DDR5 DRAM, directly driving gross margin expansion for the memory oligopoly. Drilling down into the foundry level, TSMC maintains a virtual monopoly in 2.5D CoWoS packaging, capturing an estimated 92% of the AI accelerator packaging market. This represents a formidable economic moat. While TSMC's blended corporate gross margin hovers around 53%, our sum-of-the-parts analysis indicates that their advanced packaging segment operates at accretive margins approaching 60% at scale. The capital intensity required to replicate this infrastructure creates insurmountable barriers to entry for secondary foundries. TSMC is aggressively expanding its CoWoS capacity, targeting 40,000 wafers per month by year-end 2024, representing a 150% year-over-year expansion. From a portfolio perspective, TSMC's pricing power in the packaging node effectively allows them to capture a disproportionate share of the economics from fabless GPU designers. We view TSMC as the primary beta vehicle for advanced packaging capacity constraints. Pivoting to the memory oligopoly, high-bandwidth memory is fundamentally altering the margin profile and return on invested capital for SK hynix and Micron. SK hynix currently dominates the HBM3 and HBM3E supply chain, enjoying first-mover advantage and an estimated 65% market share in AI-centric HBM. Our yield analysis indicates that HBM production is incredibly complex. The through-silicon via and microbump processes result in initial base wafer yields of only 60 to 70%. This structural yield challenge effectively limits global supply output, sustaining the aforementioned ASP premiums. Micron's entry into the HBM3E market with a claimed 30%. Moving downstream to the equipment providers, we highlight the asymmetric upside in capital equipment vendors specializing in advanced interconnects, specifically BESI and ASMPT. As the industry transitions from traditional thermocompression bonding to hybrid bonding for sub-10 micron pitches, BESI commands a dominant market position. Hybrid bonding allows for direct copper-to-copper connections, essential for next-generation 3D stacked HBM and logic integration. BESI exhibits best-in-class financials, maintaining gross margins north of 64% and operating margins exceeding 35%. This margin profile is indicative of monopolistic pricing power within their specific niche. We model BESI's hybrid bonding system shipments to accelerate from 40 units in 2023 to over 250 units by 2026. ASMPT serves as a secondary play with broader exposure to thermocompression bonding. Capital allocation into these equipment providers offers a pure-play picks and shovels exposure to the packaging supercycle. Turning to valuation multiples and peer comps, the advanced packaging and HBM cohort is currently trading at a justifiable premium to the broader semiconductor index. On a next 12 months or NTM PE basis, the advanced packaging equipment group is trading at 32x, compared to traditional front-end equipment peers at 21x. Analyzing EV to EBITDA multiples, key players like BESI and SK Hynix are commanding multiples in the 18x to 22x range. While headline multiples appear elevated relative to historical means, adjusting for our projected EPS growth yields highly attractive price-to-earnings to growth, or PEG ratios, of approximately 0.8 to 1.1. We argue that institutional consensus is currently underestimating the duration and magnitude of the gross margin expansion phase. Free cash flow yields remain robust, averaging 4.5% across our coverage universe, providing a substantial margin of safety supporting share repurchase programs. To maintain analytical objectivity, we must rigidly define our bear case scenario. The primary downside risk involves an accelerated CapEx digestion cycle and a potential localized supply glut by the second half of 2026. If hyperscalers curtail their AI cluster buildouts following the initial generative AI training phase, the aggressive capacity expansions currently underway could lead to severe utilization rate compression. Under our bear case modeling, a 20% reduction in projected GPU shipments in 2026 would compress HBM ASPs by 35% and contract CoWoS packaging margins by 800 basis points. Additionally, geopolitical risks remain a systemic overhang. A disruption in the Taiwan Strait would immediately halt over 90% of global AI packaging output. Finally, failure to push hybrid bonding yields past the 80% threshold could stall the transition to next-generation architectures, capping EPS upside. Conversely, our bull case analysis models a definitive pull forward in next-generation architectures, driving significant multiple expansion. In this scenario, the transition from training to widespread edge inferencing creates a sustained, multi-year demand vector for custom silicon architectures. As hyperscalers increasingly design proprietary ASICs, the reliance on flexible, heterogeneous chiplet integration scales exponentially. Furthermore, our bull case aggressively prices in the commercialization of silicon photonics integration within the package. By replacing copper interconnects with optical I/O, we eliminate the final bandwidth bottleneck, catalyzing a massive replacement cycle for networking and compute hardware. If this inflection point occurs by 2027, as modeled in our upside scenario, we project an additional $15 billion in TAM for advanced packaging equipment providers, driving a 45% upside to our base case price targets and expanding terminal value calculations across the sector. In conclusion, our rigorous fundamental analysis indicates that advanced packaging and high bandwidth memory are the definitive choke points of the artificial intelligence revolution. The value proposition has fundamentally shifted from monolithic die manufacturing to complex, multi-dimensional chiplet integration. We maintain an overweight rating on the advanced packaging equipment subsector, specifically favoring BESI for its monopolistic positioning and hybrid bonding. We initiate SK Hynix with a strong buy based on its HBM3E yield advantage and sticky hyperscaler contracts. While TSMC remains a core holding for foundational beta, we advise portfolio managers to allocate alpha-seeking capital toward the specialized equipment and memory pure plays. We encourage institutional clients to review our detailed DCF models and sensitivity analyses available on our proprietary research portal. Thank you for your time, and we will now open the line for questions regarding our valuation methodologies and capacity projections.